Welcome to CEF Insights, your source for closed-end fund information and education brought to you by the Closed End Fund Association and available on our website at www.cefa.com. Today we are joined again by Tom Roseen, Head of Research Services with Refinitiv Lipper and author of the Fund Market Insight Report, which provides in-depth monthly commentary on the closed-end fund market. We're happy to have you with us today, Tom.
Good to be with you, Diane. Thanks for having me.
Tom, you recently published your report for June 2021, which covers over 600 closed-end and interval funds. How did investment markets generally perform in June, and what was the impact on closed-end funds?
An interesting month. It started out pretty good. Everybody was elated with the global reopening of the economies. The Fed came out and committed to, keeping monetary policy pretty easy. All the borrowing going on, it was going to continue on, and they said anything inflationary was probably transitory. And it went pretty well throughout the month, especially after we got a Goldilocks, I will call it, May non-farm payroll report, which basically kept investors engaged. I mean, this is where we saw, a report of about 559,000 new jobs, and I say new, but just jobs in May created in the U.S. economy. But analysts expected 671. Well, that was good because it wasn't too low, it wasn't too high, it was just perfect, and a lot of people thought the Fed will probably keep to that easy monetary policy because of that. I mean, we saw inflation tip its head quite high. I mean, if we look at CPI, the Consumer Price Index, it was up 5% on a year-over-year basis in June, which was the highest and fastest in 13 years. But, investors basically took the Fed at its word, saying, okay, they're going to keep rates low. And so they kind of started the party. So the interesting thing that we can take a look at is certainly the Fed governors on the FOMC board, that's the policy setting committee, basically changed their dot plots, indicating that we'll have two hikes in 2023. Originally, if you recall back, they said that was not going to be changed until 2024. And in fact, one of the St. Louis presidents basically came out and said, hey, I could see rates hikes as early as 2022. So there was some hiccups during the month. But another thing that investors had to be concerned about was oil hitting a 2-year high. And the reason I bring this up, it's going to play through to performance of closed-end funds as we go here. Basically, we saw near-month crude oil prices rise to 73.47. Again, that's an over 2-year high, a 10.78% change for the month. But ironically, after all this happened, we saw the 10-year Treasury decline by 13 basis points. That certainly doesn't sound like the bond market is thinking inflationary issues. And this turned out, again, it closed down to about 1.45%. We haven't seen that for a little while. And this turned out to be a tailwind for tech stocks, but a headwind for financials and anybody else who was really playing the reinflation trade. So that lost a little momentum. But how it broke out is if we take a look at it, the NASDAQ did pretty well. Again, techs were in favor. Again, interest rates went lower. So we saw the NASDAQ rise about 5.49. The Dow was slightly negative, about minus 0.08. How that played through, though, if we take a look at this, is in June, the average equity closed-end fund had a 1.34% return. It's certainly not bad. I know we're used to seeing these 4 and 3 and 2% returns. 1.34 annualized, that's a great number. But if I take a look at Q2, it's even better. The second quarter of 2021, 6.89% for the average equity closed-end fund. And year-to-date, they're up a whopping 13.89%. Now, if we take a look at fixed income funds, they're not up as strong, but again, we wouldn't expect them to be. For June, up 0.85%. For Q2, we're up 3.18%. And we saw that for the first half of the year, up 4.36%. So overall, really a good start for closed-end funds. And actually, the market in June was certainly pretty good.
Your data breaks out closed-end funds into over 20 classifications. What classifications were the best performing for the month, and which sectors struggled?
Well, let's take a look. And by the way, I didn't give you any market price returns. Usually we'll talk about that, but I'm going to stay on the NAV-based returns here. I think that's probably the most pertinent that people can take a look at. So if we take a look first at the macro groups, we saw on the equity side, mixed asset funds actually did the best. It's the first month at 8 that mixed asset funds did better than the other cohorts. Domestic equity funds just slightly behind, 1.65%. And world equity funds struggled a bit, just rising 0.03%. Again, this is the idea of the reinflation or reflation trade was actually off. People went back to techs. I won't say the stay-at-home stocks, but certainly the tech run was certainly in play here. And so when we take a look at this, we see that once again, for the third consecutive month, energy master limited partnership closed-end funds did the best, 4.82% against a third consecutive month. They've been at the top of the list. Entering in May's laggard, convertible security closed-end funds actually did the second best return, 3.33%. And it makes sense. We had interest rates go down, we had markets hit new highs, and it certainly played into the convertibility of convertible securities. The other piece, and this is back to that idea that energy and oil did well, is up over 10%. Natural resources funds was the third best performer, up 2.34%. At the bottom of the barrel, though, we did see developed markets funds lose about 1.83%. And again, this is the idea that, first of all, the dollar strengthened, so there was a little bit of exchange trade issue going on, causing a little bit of a decline in return, but also the idea that there's still some concerns about the Delta variant of the COVID virus and the like, and so there were some concerns out there. Now let's take a look at the fixed income side. So for the first month in four, we saw domestic taxable bonds rise to the top. People were in favor of world last month and the month before, but domestic taxable bond funds were up 0.89%. Muni bond funds just right behind, 0.83%. And world bond funds fared a little bit better than their equity counterparts if you're taking a look at fixed income versus equity, but world bond funds were up 0.66%, so just about under a whole percentage point. But basically, people remained yield focused. So corporate debt BBB rated funds, these are kind of the funds that, again, they're a little bit higher quality. People are still going for yield, but for the first month in 15, they were the top performers, up 1.43%. Their leveraged equivalents of corporate debt BBB rated leverage funds were up 1.35%, and high yield munis was the third best performing category on the fixed income side, up 1.11%. And emerging market hard currency debt funds actually lost a little, down 0.37%. But the story that we've talked about in the past, munis were on a roll, fourth month in a row that they've seen plus side performance with all 9 classifications in positive territory. So that was the story with the macro groups and the individual classifications.
Is this a change from what you saw earlier in the second quarter?
It is. We saw that the second quarter really had more of what I was calling the reflation trade going on. So we saw tech kind of take it on the chin. We saw people moving towards commodities, infrastructure-related pieces. Financials were doing better because, we were getting interest rate hikes out of it. So we did see a little bit of a change of pace, and certainly that is something that we're going to keep an eye on. So this month, I won't call it unique, but a lot of people were going back to the tech issues, going back to the stay-at-home stocks, for the cliche term to be used, and paid less attention to the value-oriented plays and the other issues that were out there.
Do you expect these trends to continue into July and August?
I do. Again, I think the reflation play will come back into play here, though. I think that people are going to pay attention to what the House just passed, and certainly if they're hoping the Senate will pass it. Keep in mind the infrastructure bill was something that even Trump was in support of, and the Republicans, and now the Democrats in charge. I think they can, find a common place there to do that. But I think we're going to see more of that inflation trade going out, and basically paying attention to those type of plays that are going to get the most out of it. So we're going to see maybe commodities, natural resources, maybe even some of the basic materials do a little bit better, but I do expect it to go. But of course, one of the things we got to keep a look on is that while techs have done really well, they could continue on, but real return funds are something I would pay attention to. And then certainly if we take a look at inflation is transitory or not, we're going to have to pay attention to what's happening in the bonds. If we see a big increase in inflation or the treasury yield really climbs, we could have some problems in the bond market.
The way closed-end funds trade in relation to their net asset value is an important consideration for many investors. Did you see any specific trends in premium discount behavior for June?
Well, we continued on to another good month for decline in the discount to NAV. So basically, we saw that on a market basis, they were trading the average closed-end funds saw a discount narrow or improve 38 basis points to 2.42%. That is much better than the 12-month moving average that we saw at 6.48%. And just so people know, I use the word median in this case. So median is what we basically take a look at to get rid of the outliers. There's some big funds that have some huge premiums, huge discounts. We use the median, but we are using a moving average on that number of 6.48. So 2.42 is absolutely outstanding. If we take a look at the average closed-end fund equity, so the equity fund widened a bit, about 18 basis points to 4.33%, still a very respectable number. And then we saw the average fixed income closed-end fund narrow about 66 basis points to 1.52%. We haven't seen it that low in quite a while.
How do current premiums and discounts compare to their historical averages?
So I'm not going to go way back because I said for quite some time, that 1.42%, that is just really low for years. But let's go back to just a time period that we've seen, 12-month period. So if I take a look at all closed-end funds, I don't care equity, fixed income, combine them all, in June of 21, this month that just passed, we saw a 2.42% discount. Now, if we go all the way back to July 2020, it was at 8.72. And to put this more in perspective, we have 149, as of June 30th, we had 149 funds trading in premium territory, while 308 were at discounts. If we take a look at that in July of 2020, it was 74 trading at a premium and 405 at a discount. So we've seen a big change. Taking that though one step further and taking a look at the equity and fixed income. Equity funds this last month, 4.33%. A year ago, 11.96%. Fixed income funds, 1.51% versus a year ago, 7.2. So it has been a really complete turnaround. And some people might say maybe that's just over exuberance going out there, but certainly we're seeing a very deep narrowing going on. And certainly I'm sure all closed-end fund investors want to keep that going, obviously, but it's been a big change.
Which sector saw the greatest change?
So I said equity funds saw a slight increase during the month, and basically domestic equity funds were the culprit. They saw the largest widening of their discount, worsening, if you will, 112 basis points, but only to 2.90%, so still very good. Single state munis saw the largest narrowing, about 139 basis points to 2.93%. All of them very respectable numbers.
Tom, equity markets had a good second quarter. Economic growth has rebounded and interest rates remain low, but there are some concerns about the potential for inflation with the degree of economic stimulus we are seeing. Are there sectors among closed-end funds where investors may find particular opportunities given where those funds are trading relative to their historical averages? And how do you see the direction of the markets?
So this is one of the areas that I think it's the million-dollar question for everyone. Does the Fed come out here shortly? Certainly we know that they're going to be having their normal Fed meeting at the Jackson Hole. It's their economic policy meeting in August. So we'll be keeping a clear eye on that. But when we're taking a look at this and looking at kind of historical trends, if we believe that inflation is going to continue on, if we believe that there's going to be infrastructure spending, some of the sector equity funds have some unique positions. There's some real asset funds out there. And when we talk about real asset funds, obviously there are the funds that, they might have some commodities or gold or might have oil, but they also have machinery that can be used in infrastructure development. So that's something I think people are going to be taking a look at. Funds that have, a focus or, holdings within the basic material areas, I think they might have a chance here. And certainly if we see a little bit of rise at the long end of the curve, which again was just the opposite of what happened, we saw the long end of the curve actually go down and flatten the whole curve. But financials could become more important as well. And I think people saw that the stress test that the Fed did showed that certainly the financials, the banks out there are in good financial positions. So that's an area. Two other areas on the equity side I think that are interesting looking at, and again, this is a lot more risk, but a lot of people have been talking about the developing markets, developed markets and emerging markets. Didn't really participate. If we see the emerging markets, we see oil and gas and natural resources and those materials doing better, certainly could be a play. Have to do some deep research in that. And the same with the developed markets. So we've seen a recent rise in, let's say the FTSE, the London Stock Exchange and some of the more developed countries, but they didn't participate the way U.S. did, so we might see some plays there. For those undecided, though, there's two areas that they could take a look at. Option strategy funds are something that have historically, at least during this rally, not done as well as some of the other equity groups. In fact, for the quarter, the group is up, but only about 6.12%. For instance, Energy Master Limited Partnerships up 19%. 19.02 for the quarter. So they didn't participate in this most recent rally, and they use covered calls, and they're also buffered funds, building in some declines while you can still participate on the upside. So those will be interesting to take a look at. And on the fixed income side, if you anticipate that we are going to have some inflationary fears come ahead of us, and see it, loan participation funds still could have some opportunity to shine, along with global income funds as well.
Tom, you also follow interval funds, which typically offer limited quarterly liquidity to investors. How have interval funds generally performed in the second quarter of 2021?
Well, they actually didn't do as well as they have in the past. We've always said there's kind of a 50-50. This time, if I take a look at the numbers are pretty starkly different when I take a look. If I look at, and this is a little bit of an apples to oranges comparison, but if we do take a look at the actual returns, we saw that interval funds returned about 3.65% on average, where if we take a look at the conventional closed-end funds, they were up about 5.51%. But that's because we have areas, for instance, like energy master limited partnerships, or let's even go to one, natural resources funds, up 10%, 10.99% for the quarter. But there are no interval funds in the natural resources space. So that, what I was giving you is kind of a mismatch and not a great way to be able to take a look at them. But if we do take a look at the categories that we talked about, in real estate funds, for instance, there's 33 interval funds, 9 conventional closed-end funds. Basically, they underperformed considerably, about 4.29% for the average interval fund that's in the real estate space versus 1.39%, 11.39%, I'm sorry. So there were some big differences, but most of these are pretty small, to be honest with you. If I look at loan participation funds, interval funds were up 2.12%, while their conventional counterparts were up 2.74%, so we were really close there. Income and preferred stock funds, 4.52% versus 4.98%. One area that we saw that was actually a pretty big outperformance was in the global income category, and it was 7.51% for interval funds versus 3.28%. So that was quite a difference that we saw. But I will have to say that is because of one fund with 4 different share classes. Remember, these are interval funds, so they're structured a little bit like the conventional fund with share classes. And while I'm not recommending this at all, I'm just pointing out that this is why they outperformed. Basically, we saw Blue Bay, Destra International, and Event-Driven Credit Fund. They're different share classes. Take the top 4 positions in that category for the quarter. So again, no recommendation here, but just pointing out the fact that they outdid. So interval funds didn't do as well as they've done over the last several months and quarters, as we've talked about. But certainly, again, this is just one period of time where they underperformed slightly in most cases.
What asset classes or investment strategies do you believe offer the most interesting opportunities for interval fund investors in the current market?
The global income funds, I think, is an interesting one. Again, I would be cautious on this. Remember, the blue, and again, this has to be because it's that classification is made up of those 4, or actually, I should say, that classification for interval funds is only made up of one fund, the Blue Bay, Destra International, and Event-Driven. So if you kind of like that, if you will, alternative type of fund, that might be something to get into. The other side is, if we take a look at it, when we're worried about the inflation rearing its ugly head, again, loan participation funds certainly is a big space in this group. So interval funds is about 26 loan par interval funds versus 27 conventional funds. So certainly that is something that I think people keep an eye on as well.
Tom, thank you so much for taking the time to join us today.
You're welcome, Diane. Thank you so much for having me.
And we want to thank you for tuning in to another CEF Insights podcast. For more educational content, please visit our website at www.cefa.com.